Choosing between a fixed and a variable rate can be one of the hardest decisions somebody has to make when getting a mortgage. And quite often, we see a lot of people making a lot of mistakes when they're choosing between the two, because they really don't know how to make the proper decision. And there's no better evidence of this than what happened in 2021 and 2022, when so many people chose variable rate mortgages, not understanding what they were, how they worked, the potential downsides, and most importantly, the difference between the different types of variable rate mortgages. So in this video, I want to give you the full picture on variable versus fixed rate mortgages by showing you exactly which mistakes you need to avoid and how to actually choose between the two. But before we get into it, my name is Nolan Matthias, and I've been selling mortgages for the last 20 years. Yes, I know what you're thinking, and I did start when I was 5. And part of the reason why I put this channel together is to share this type of information so that people don't make the mistakes that they made, well, in 2021, 2022, when everybody watched 13-minute YouTube videos thinking that that was going to get them the answers they needed, but in reality didn't give them the full picture. So this video is designed to give you the full picture. And by the way, if you want the latest Canadian financial and real estate news, this is the place for you. So hit the subscribe button and hit the like button so more people like you can see this video. And by the way, every dollar that I make from YouTube AdSense on this channel is directly put into a charity every single month. So in the comments section below, tell me which charities you think we should be supporting this month so that, well, we can do some good in the world. Okay, so let's get into it. Let's discuss the most common mistakes people make when choosing between variable and fixed rate mortgages. And this will hopefully help you decide between the two by having better information so that you don't get screwed and you don't choose the wrong one. So let's start by talking about the first major mistake that people make when choosing a variable rate or a fixed rate mortgage. And that is not first assessing their risk tolerance. In other words, you should be assessing exactly how much pain you can withstand if the worst case scenario happened. Because if you're the type of person who can't stand the thought of your payments going up, or if you have a spouse, for example, who can't stand the thought of their payments going up, well, that could be problematic if you choose a variable rate. Or if you're a first-time homebuyer, you've never done this before, well, then choosing a fixed rate may be obvious for you. But this should be where you start. Is it going to keep me awake at night knowing that my interest rate could go up overnight by 25 basis points or 0.25% or percent, or in a worst case scenario, 5% like it did in 2023. And interest rates going up or down and being volatile isn't the only risk that you need to assess. The next is the payout penalty risk. And what do I mean by this? Well, if you do end up choosing a fixed rate mortgage, there is a possibility that at some point you may decide that you want to sell the property or refinance or get a lower interest rate at some point. And if this is the case and you have a fixed rate mortgage and short-term interest rates have gone down, so in other words, 1, 2, 3-year rate mortgages have gone down in price, well, that could trigger what's called an interest rate differential. And depending on the lender that you choose, this could become very expensive. So if there's a possibility that you may be changing up things with your mortgage in the next 5 years, a fixed rate mortgage may in fact not be right for you. And most importantly, you need to make sure that you're choosing the right lender when it comes to your fixed rate mortgage, because the lender that you choose could actually affect the amount of the interest rate differential and how big your penalty is. And in some cases, it could be 3 to 5 times higher if you choose the wrong lender. And I'll get to this a little bit later on. But don't underestimate the importance of the payout penalty risk, because most people think that they're going to buy a property, they're going to live in it for the next 15, 25 years, and that they're never going to have to worry about a penalty. And that's just not the case. In fact, most mortgages don't make it past 2.67 years. So in other words, the large majority of mortgages in Canada never make it to the end of their 5-year term. And I'll never forget the clients that I had that moved here from Ireland. They thought, hey, in Ireland, we always live in the same home for not just decades, but our kids live in it and their kids live in it, and we're never going to have to worry about a payout penalty. Well, you would not believe the shock when I got a call one day, just 2 years after putting a client into a mortgage that they asked for that had a massive 5-year fixed penalty. And ironically, I got a call from the client who was in absolute tears, a call from the lender giving me a heads up that the client was probably going to be calling me, and a call from the realtor who was really pissed off because his commission was in jeopardy because they had this massive penalty and he may not be able to sell this home. And this was one of the first mortgages I ever did with a lender that had high payout penalties, and honestly, It still bothers me to this day because they knew the risk, but they chose that lender that had high payout penalties anyways because they thought they were good. And obviously they weren't. Now, everything ended up working out in the end, but this was a lesson not just for me, but for the clients in all things interest rate differentials, and why you also need to assess the penalty risk when you're choosing a 5-year fixed mortgage. Oh, and by the way, if you choose a variable rate mortgage, you still need to be thinking about this because oftentimes if you decide you're going to lock in, you may have to lock into a 5-year fixed. And if you lock into a 5-year fixed, you then expose yourself to the payout penalty risk. So choosing the right lender, again, like we'll talk about in a minute here, is very, very important. Then there's the big mistake that many Canadians made in 2021, 2022, and 2023, and that was not understanding the difference between different mortgage types. And of course, this comes down to watching that 13-minute video, not getting expert advice from a good broker, and knowing what mortgage they were getting when they actually signed on the dotted line. Now, a good mortgage broker will help prevent you from making the wrong mortgage decisions, but if you want a great mortgage broker, well, my team at Mortgage 360 is here to help. They are some of the most hardest working women. Yes, they are all women because they just kick ass, and they are some of the most caring people that I have ever met. And their primary mission is to make sure that people don't choose the wrong mortgage, which is why if you don't already have a great mortgage broker, they would be the people for you. So go to mortgage360.ca in order to connect with one of them. But let's talk a little bit further about the different types of mortgages. So first there is full featured mortgages, and then there are discount mortgages, and then there are bank mortgages, which are the ones that tend to come with the highest payout penalties. Now, discount mortgages often come with different things that could hurt you in the future. Maybe reduced prepayment privileges, maybe the inability to port the mortgage to a different property, which can be important, and most importantly, the inability sometimes to be able to pay out the mortgage and switch to a different lender if there's an opportunity to get a lower interest rate, which if interest rates do go down, you want to make sure that you're choosing a lender that will allow you to pay the penalty, whatever cost that is, and hopefully it's low. It's not at a B lender or a bank, it's at a monoline lender like a First National or an MCAP, so that your payout penalties are reduced, but you want to have that ability to be able to actually switch lenders and get a lower interest rate so that you can save money in the future. You've probably heard the saying, marry the house, date the mortgage. Well, you want to make sure if you're going to date the mortgage and not commit long term that you actually have the ability to break up with your lender. Then there is the different types of variable rates. There's variable rates with fixed payments, and then there's what's called adjustable rates. And adjustable rate mortgages have mortgages that, yes, float in the exact same way that normal variable rate mortgages float, but they have one key difference, and that is that your payment changes every time the interest rates change. And what this does is it allows you to feel the pain of interest rate changes more gradually. And it also allows the mortgage to amortize at the normal rate, which means you won't find yourself in a position like many people did over the last couple of years with a mortgage that negative amortizes, ends up costing you way more in interest than you ever thought possible, and puts you on a 30, 40, 50-year track to pay off your mortgage. And nobody wants to be in a mortgage for 30, 40, or 50 years. It's not a fun thing. So understanding the difference between the different types of mortgages is hugely important. Oh, and by the way, if you want more information on that, you can get my book, Mortgage Secrets, for free. All you have to do is pay the shipping and handling. Just go to mortgagesecrets.ca to pick that up, and it goes into deep detail about all of the differences between the different types of mortgages. Now, I mentioned earlier this next mistake, which is choosing the wrong lender. And I'm going to make this as clear as possible. In this day and age, it doesn't make any sense to go directly to your bank to get a mortgage. You can actually hire somebody called a mortgage broker who in most provinces legally has a fiduciary duty to you, which means they have to do by law what is in your best interest. By the way, people who work for the bank don't have that same obligation. In fact, the obligation is the opposite. They have to do what's in the best interest of the bank, which means that their job is to get as much money out of you as humanly possible. So in today's day and age, it makes sense to go to a broker who understands the various different lenders and can put you in the right one for you. And quite often, this means not going to a bank. It means going to a lender that has low payout penalties, the ability to lock in if you do end up choosing a variable interest rate to an interest rate that's going to be competitive to those that are available on the open market, and that will save you a ton of time. So having that agency relationship, somebody to represent you, It just doesn't make sense to not have that. And by the way, there's no way, zero chance that you'll be able to walk into a bank and get as good of a deal as a broker can get you. But the important thing to remember is that a good deal isn't just about the rate, it's also about the features and, like we talked about before, the lock-in rates and the potential payout penalty risk that comes with it. And by the way, of everything we've talked about so far, this is the most important thing you need to pay attention to, choosing the right lender. But not quite as important as the next one, which is the massive mistake that many people made, and that was relying on forecasts to make their mortgage decision. And I can't emphasize this enough. People who choose their mortgage based on what they expect to happen quite often end up in a situation where what they expect to happen doesn't happen, and they end up spending way more money on something than they should have. So the only way to reasonably choose between a fixed and a variable rate mortgage, if you can deal with the risk and you don't have to worry about the payout penalty, is by basing it on the information that you have that is current as of today. Which means if you can get a fixed rate mortgage for significantly lower than you can get a variable rate mortgage, you choose a fixed. And if you can get a variable rate mortgage for about the same price or significantly cheaper than what a fixed rate mortgage would be, you choose the variable. And there's a bunch of science behind this. It all comes out of a study done in the early 2000s by a guy named Mosh Milevsky at the Schulich School of Business, where he assessed all of this. And the reality here is, whatever mortgage is the cheapest at the time, statistically speaking, is going to be the mortgage that is going to save you the most money. Now, there are times where this isn't true. Outlier situations where interest rates go up a ton because there's a pandemic and massive inflation as a result. But more often than not, the risk of interest rates going up substantially like they did in the last few years is low, which means that if you can get that variable rate for cheaper and you can deal with all the risk associated with getting it, that it's probably going to save you money. And in that same vein, if a fixed rate mortgage is priced 0.75% to 1% lower than a variable, the chances of interest rates coming down significantly enough to make up for the amount of savings that you're going to have initially when you get that fixed rate mortgage is slim to none. And keep in mind that if a fixed rate mortgage is 1% cheaper than a variable rate mortgage, well, the interest rates don't actually have to come down 1%, they have to come down 2% so that it makes up for all of the time that you spend paying a higher interest rate if you were to, in fact, choose that variable rate mortgage. Because if the fixed rate mortgage is 1% cheaper than the variable and interest rates drop 1%, well, now you've just got a variable rate mortgage that's priced exactly the same as that fixed rate mortgage was at the beginning, and you've spent a bunch of time waiting for the interest rates to come down where you've paid more. So you actually need the interest rates to come down more than 1% in order to be better off. Unless, of course, you've got that scenario where you might have an interest rate differential and a payout penalty, and this is where, again, having a great mortgage broker comes into play, because you can see it's pretty complicated and they'll be able to ask you the right questions in order to help you make the best decision for you. And while you may not make the best decision every single time, the likelihood of you making the right decision will be significantly higher if you've got that person who understands mortgages and understands the blind spots so that you don't make any of the mistakes that I just talked about. Oh, and if you want to know more about mortgages and all the things that could possibly be relevant to you, make sure you check out one of these videos right here.